In this video, I'm going to give you the top tips and tricks to maximize your tax refund. So here are your tried and true ways to reduce your tax liability during tax time so that you don't have to pay more than you have to and may even increase your tax refund when it comes time to do your taxes. Hey, what's up guys? My name is Chase and this is a Painting Pinter's Guide to Personal Finance and Investing. If you're interested in more videos like this and finding out other ways to increase your tax refund and increase that money, then go hit that like and subscribe button and we'll jump right into the video. And at the end of this video, I'm going to give you the secret to get the biggest tax refund possible, as well as not having to pay to do your taxes. So stick around for that. While many Americans do not agree with the way that the government is spending their taxes, almost every American will agree that they do not want to pay more than what they actually owe in taxes when it comes to tax time. Or even they want to save some money or even boost their refund when it comes to that time. So that's why in this video we're going to focus on ways to increase your tax refund and reduce your liability so that you get the maximal amount of tax refund this tax season. So the first thing you need to know about when you look at increasing your tax refund is knowing the difference between a tax deduction and a tax credit. So a tax deduction is actually going to just reduce the total taxable income or the adjusted gross income or AGI that the tax and the governments see you making. Whereas on the flip side, a tax credit will actually reduce the total amount of taxes that you have to pay by reducing your total tax bill by that specific credit. So it's kind of hard to understand just based off of those words, but when you look at it in an example, it's really easy to understand. So for this case, would you rather have a tax deduction of $10,000 or a tax credit of $10,000? So when we look at it this way, you can actually see that with a tax deduction of $10,000 versus a $10,000 tax credit with a same adjusted gross income of $100,000 for both of these parties, and you get less of a tax burden by reducing your adjusted gross income down from $100,000 down to $90,000 at a tax rate of 25%, calculates down to a total taxable tax of $22,500. So your total tax bill, if you have a tax deduction of $10,000, would be $22,500. Whereas if you compare that to a tax credit, your adjusted gross income is still $100,000. There is no tax deduction. Your taxable income is still the $100,000 at a tax rate of 25%, and then calculate it out. That gives a $25,000 tax bill at the end of the year. But if you have a $10,000 tax credit, that will drop that $25,000 down to $15,000, and that will actually make your total tax bill less than if you had that deduction. Now this sounds great and all. Tax credits are a little bit less to come by than actual deductions, and these specific credits don't always work out because some are non-refundable and some are refundable. So if you have a non-refundable tax credit and you end up having to pay $1,000 in taxes and you have a tax credit of $2,000, you're not going to end up getting paid an extra $1,000. It just will make your total taxable tax bill at the end of the year down to zero. Whereas if it is refundable and you do have a $1,000 tax bill and you have a $2,000 tax credit, then you will end up getting an extra $1,000 at the end paid back to you. So the fine details do come down to how important it is in looking to see if they are non-refundable or refundable, and if it's a credit versus a deduction. So using the right credits and the right deductions in the long run will make a big difference. All right, the next thing I want to talk about is going to be looking at your deductions. You have your standard versus your itemized deductions. For the most part, most people out there will want to use a standard deduction, and it has a set amount depending on your filing status. So you can either file single, married filing jointly, married filing separately, or head of the household. And depending on the tax year, this number will be adjusted based on what the government thinks is appropriate for that particular standard deduction. Now, if you want to go down the itemized route, then you can do that. It just depends. There are only certain things that will fit into this category. Now, specifically speaking, real estate taxes, mortgage, interest, and charitable donations will fall into that, as well as a couple other things. But those are some of the bigger ones that may go into your itemized deduction and may tip it over that particular standard deduction. So now you might be asking, well, why? Which one do I pick, standard versus itemized? Well, specifically, you're going to pick the one that's going to give you the best benefit. So whichever deduction is going to have the highest value will then deduct from your adjusted gross income and make your total taxable income even lower. So it's pretty simple. You're going to pick the highest one, that fits best with your situation. So in the end, focusing on your tax deductions and credits will actually help you increase your tax refund and decrease the amount of taxable tax liability that you have. So I'm going to go over some of the top 10 tax deductions out there that you will probably be able to utilize and help reduce your tax burden. So coming in at number 1 is going to be the standard deduction, is the one that we talked about earlier, and that's going to be based off of your filing status. This one is pretty standard, and I'm not going to go too heavy into that one. One that people don't always think about is going to be the IRA contribution deductions. And if you're interested in this, pretty much anytime you're putting the max amount into your IRA, you're going to be meeting this full contribution deduction. And here at Penny Pincher's Guide, we recommend focusing on maxing these out on a yearly basis so you can get the full deduction, as well as it can help you out in the long run for your retirement. Number 3 is going to be a health savings account deduction. If you do utilize this on a regular basis, the money that you place into that health savings account is pre-taxed money that is saved for the medical expenses. And to qualify this, you do need to have a high deductible healthcare plan. But specifically for 2022, the contribution limit is $3,650 for singles or $7,300 for families. So just like I said earlier with the itemized deduction, you can also have local or state taxes, and based off of those taxes that you pay, you can then calculate those up, and that could potentially pull up your itemized deduction bill up to $10,000. Another big one could be that if you have a medical expenses that were up in the high amounts, if you were driving there or if you're spending a lot on medical bills, then that can actually be calculated into your itemized deduction, and you can use that to go into your deduction as well. Today's day and age, in the 2022 and 2023 time frame, if you did have a home office and you're working from home and you're self-employed, then depending on the size and the amount of work that you do there, you could potentially deduct some of that on an itemized basis. So the simplified square footage method assigns a flat $5 per square foot rate to your home office up to 300 square feet or up to $1,500 per year. Another one could be the student loan interest deduction, and this one is going to be based specifically on the interest that you're paying on your student loan, and this one is capped out at $2,500 for that time period. The next one would be if you do own your own house, your mortgage interest deduction, and you can basically claim up to the first $750 of mortgage principal as a deduction. And the last one I do want to talk about is going to be the charitable contributions tax deduction, and it's one of the ones that people will be using most often. And if you are focusing on the itemized, then you can go based off of how much you do donate. But if you are filing jointly and you're taking the standard deduction, then you can get up to $600. Even if you're not itemizing it, you can also get it for the standard part as well. So if you combine the knowledge of the deduction versus the credit and then being proactive about getting the correct ones that fit right with your situation and filing correctly, that is how you're going to get the highest deduction and the highest refund based on that, and you'll also be able to reduce your tax liability. Hope you got some good information from this video. If you're interested in learning how to file your taxes for free and not have to pay your taxes, then there will be a link right up here. Hope you got some good information, and we just want to remind you that we are here from your first penny to your first million. We'll see you next time.